Hello, guys. Welcome to PRS. My name is Tsire, and I'll be your educator for today. So, today's session is a continuation from last week's session. So, I hope you saw the group accounting foundational video, as today will be a continuation of it. So, um, I'm just gonna go through it again, and we are also going to do a question. So how to apply what I told you like in a question. Okay, so let's start. Um, so the first thing is before I start with this, I just wanted to go through this. So there is the MM approach. So this MM approach, I suggest you use it, especially you'll see, I'll even show you how we use it in question papers, because it's very important to know where you are in the process when you are reading the scenario and the required. So I'll teach you how to um, apply this MM approach, and you'll see it's easier when you actually apply this approach to, like, it's easier to do questions when you apply this approach. So let me just go through it quickly. So firstly, perspective, especially now that you are doing group accounting, it's very important to know who you are. So you'll see there will always be a parent and then a subsidiary, right? And then the group, right? So you have to know from what perspective are you doing this accounting? Are you doing it from a separate statement level, so in the separate statement, or are you doing it like consolidation, like in the group level? But I will show you how to apply it. And then the next thing to consider is the date. So it's very important to know, especially like acquisition dates and basically how the profit will be attributed from acquisition until the current year, right? And then obviously for accounting, we use IFRS standards, right? So you'll see I'll keep referring to IFRS standard, IFRS 3. That's what I mean here when I say legislation. So legislation or standards. So here we use standards. So you'll see for groups, we'll use mainly IFRS 10 and IFRS 3. But I'll show you, I'll also tell you what standard you are using, right? And then we have the trigger, right? The trigger basically is it's basically an event, right? An event or information or a requirement that's gonna um, basically help you or help you get an idea of what standard the question is actually asking. Because, like I said, you use this approach while you are reading the scenario and in the required, and it's very important to know what you are doing. You see, and then that's the trigger. So the trigger for group statements, it's very simple. The trigger for group statements, it will be when you see an entity purchasing another entity, right? So it's purchasing some like shares in another entity, right? Or the assets and liabilities of that entity. That's the trigger for groups, right? And the trigger maybe for IFRS 16, it will be something like an entity buys, like equipment or a building, that they are gonna use. Those are all triggers. So in event that happens, it's what triggers that standard, right? And then after we know that, so we have the trigger, so we're gonna have standards, right? So various standards. Now the scope is going to help us basically identify and say the trigger basically is just giving you an idea of what standards apply, but the scope is going to give you like assurance of, now this is the standard that's working. And that's where you actually do the identification process for accounting, right? That's where you'll see every standard has its own identification like process. So for instance, identifying what is PPE, what is investment property. They have their own standards, right? Like for instance, PPE, it has to be a tangible asset, those rules, right? And then after you know that this is PPE, then comes implication, right? Now, what do you have to do with this PPE, or in this case, it's the group, right? So what do you have to do to account for these group statements? Now, I'll show you how this thing works in totality. And for accounting, it's very important to know, obviously, implication. When are you going to recognize this thing? If you can recognize it, when are you going to recognize it, right? When what happens, and the measurement, like what model are they gonna use, right? Gonna use maybe the cost or the fair value, but there are different models of measurement they use, right? But I will show you how it's done. So now we're going to start with group accounting. So like I said last week, group accounting. So the trigger for group accounting is when an entity buys an interest, or like an interest basically is a stake or a share, ne? Buys a share in another entity. So in this case, I used entity B as an example. Then the first thing entity A will do, right, is determine the degree of influence it has in that entity, right? So last video, I didn't cover this thing of degree of influence. I just told you basically the steps that you have to take in order to determine this degree of influence. I said the first thing that when you see an entity, so an entity buys a stake in another entity, so you see something like this, then what has to click is, firstly, I have to determine the level, so the degree of influence I have in this entity. And I will teach you what they mean when they say degree of influence. That's very important. You even do this before you consider business combination. So before you consider the acquirer and all of those things they taught you so far. So firstly, you have to consider the degree of influence, so whether you control this entity or not. That's where you start, right? And then like I said, the first thing here, you determine whether A controls B, right? And then if it's not control, then you're gonna check for joint control. If it's not joint control, significant influence. I don't think at your level you do joint control and significant influence. I don't think on a second year level you do joint control and significant influence. So I'm just gonna teach you steps for determining control, right? For determining this, and how basically do they continue forward? Like after control, what do you do, right? So do you see that the trigger, right? The trigger is when an entity buys a stake in another entity, right? You have to check what the degree of influence, right? So then after, now we are in the scope section, right? So we are in the scope section now. We want to determine whether this entity, we actually do control this entity, right? And then so how do we determine this control? And so let's continue. Okay. Okay, sorry, I don't know what's going on with the slides. Okay. Right. So firstly is how to determine control, right? So um what is control? So an investor, what is an investor? Investor, obviously, it's this entity, right? Entity A, because it's the one that's investing. So it's the one that's actually buying the shares. So the buyer, so the buyer here. So it's the investor. So an investor controls an investee. Investee is the entity that you're investing in, right? So in this case, if there is control, and this is very important. You see in this definition, they use investor and investee, not parent and subsidiary. So before we determine control, this entity is not yet a parent or subsidiary of another entity. It's still a transaction between an investor and investee. We haven't yet ascertained whether control exists. So you can use terms like parent and subsidiary. And then so an investor controls an investee when it is exposed to or has rights to. So number one, variable returns, right? And I'll explain these things. And then, so an investor controls an investee when it is exposed to variable returns from its investment, right, with the investee, and has the ability to affect those returns through its power over the investee, right? Now, from this whole definition, so the way to apply it, so when you are in a test setting, the way to apply it, you're going to use these three elements, right? That's the elements that you're going to use. So firstly, you have to write this definition down. It's very important to know it. You have to know it and write it down. That's where you start. However, you're going to prove that control exists with these three elements, because these three elements are contained in this definition, right? So the first thing, do you see that they say the ability to affect those returns through its power, right? So we have to now determine whether we have power. So that's the first element. So determine whether we have power. So now to determine whether we have power, we have to determine what is this power, right? We have to determine the power over the investee. So what is this power? So power is existing rights that give the current ability to direct relevant activities. That's the definition of power. So existing rights that give the current ability to direct relevant activities, right? So now, even in this definition of power, do you see that the first thing that you have to consider is this relevant activities? What do they mean when they say relevant activities? And that's basically, I'd say, where that word like influence comes from, because you will see this relevant activities, it's the only thing that really determines control, right? So it's not those percentages, so it's this relevant activities, and I'll show you how. So what are these relevant activities? So relevant activities are activities that significantly affect the investor's returns, right? So I'll give you examples of activities. Ne? So let's look at operational activities, right? So there are a bunch of operational activities in a business, right? So those are things like who are we gonna sell to, our costs, right? So those decisions, do you see that they affect the investor's return significantly? So let's say A invested in B, right? So A invested in B, right? So who, like the customers that B is selling to, right? The person who decides like that, right? That's a relevant activity. Why? Because it significantly affects the returns. And what are returns, right? Returns are actually profit, right? So so these activities have to affect basically the profit, right? The returns that you're gonna get from the investor, right? So those are operational activities. So operational activities, firstly, it's like, for instance, so you see it, it's either they will call them operational activities, right? Or they will tell you exactly what they are doing, right? If you see something like decisions of where they're gonna sell this thing, where they're gonna purchase like the materials, and those are major decisions, and those decisions are operational. So operational decisions are those. So if you have a business, where you're gonna sell, um, like the cost you're gonna spend, people who make those decisions, like those are relevant, right? Because they are relevant to bringing returns. They affect the returns significantly, right? However, let's say if they said you were responsible maybe for appointing, let's say you were responsible maybe for appointing maybe someone like maybe HR manager. So maybe someone that handles just a small function, right? Small activity of the business, right? If that manager, like, you see that the activities there. So sometimes you may have different sets of relevant activities, like they say here, right? You must choose the one that, like, like it's most significantly, so it most significantly affects the returns, right? So if they give you set of relevant activities, right, they are going to group them for you at your level. They are not going to make things difficult. You're going to see exactly these are relevant activities, these are not relevant activities. But number one, relevant activities are operational activities that affect returns. So think of something that affect like returns of the or of a business, like those activities, and like the most relevant. So what affects profit the most, right? So the first are operational decisions, and those are operational decisions basically, right? And then the second class, so if they don't have relevant activities, so they don't have operational decisions, the second relevant, so the second type of relevant activities are so financing decisions, right? So how are they going to finance like the company, right? So that's also important, right? So whether they're going to use more equity or more liabilities, that's a very important activity. However, what I'm trying to say is that what's very important is to know what the relevant activities of that entity are. I can't stress this enough. Once you know what the relevant activities of that entity are, right, the only thing that's left is to see who directs them, right? So power is having the existing right that gives the current ability to direct relevant activities. And if they direct relevant activities, then they have power over the investee, right? So they have power over the investee if they direct these relevant activities, right? So you're gonna have these relevant activities, and now with basically power, ne? So power may come from two ways. So now these relevant activities, they might like tell you like exactly, because remember when entity A buys a stake in entity B, how do they buy it? It's via a contract, right? It's a financial instrument, right? So they are signing a contract, these people, right? So they sign a contract, right? And then in the contract, it has the details, right? Whether so that the details of the contract, so that power, it can originate via two things. Via first voting rights. This is the one that you are used to, I'm sure. Like if they say you own more than 50%, if you own more than 50% of the company, you control it, right? You know that one is the most common one. That one, the voting rights one. Or complex arrangements, right? So complex arrangement is, it's not via voting rights, it's via these arrangements, right? And you'll see that the reason why people use voting rights, right? These voting rights, with these voting rights, ne, just think about it properly. If you have a company, right? These voting rights, in most cases, you use them in the AGM meeting when you're appointing what directors. So obviously, if you have a like more than 50% stake, right? It means that every decision that that entity makes, like you basically will be a step forward, right? So maybe let's say they say hiring directors, right? You're gonna be you're gonna have the final say as to who's going to be hired there. So you're gonna be have the final say in terms of directing relevant activities, because directors are the ones that are gonna actually direct relevant activities, and you are the one that's in charge of the director. Do you see? So that's how this voting right system works, right? So you, if you have more than 50 vote, like more than 50 voting rights, right, then you have a majority stake, so you control the business. Now complex arrangement is what I was explaining in the slide here about so in this, yeah, here. So when I explained relevant activities, right? So with these complex arrangements, you will see they will not like directly tell you that it's via voting rights. They will tell you the relevant activities exactly, right? And then they will tell you maybe that you have the authority to appoint maybe 4 directors out of 6, right? If you have that authority to appoint 4 directors out of 6, do you see that you are actually controlling relevant activities? Why? Because directors control relevant activities. And even with voting rights, like I said, the basis of all of this is relevant activities, not returns, right? So let me say this again. So like for instance, even like someone like Elon Musk, ne? Elon Musk, like he doesn't own 50% of, like more than 50% of Tesla, right? He owns like 43%, right? However, the decisions, they are not made by voting rights. There's a complex arrangement there. He has a separate arrangement for voting rights, right? So he used a class system, right? So voting rights are separate from the returns of the business, right? So even though he has 43%, it just means that he's gonna receive 43% for returns. However, his voting rights, he has like more than 77% voting rights, right? So that's a complex arrangement because it's not via voting rights, it's via the contract itself. That's why it's important to know that this thing here, like the power, it's basically relevant activities. In fact, control is relevant activities. Once you know who controls these relevant activities, and if you do control these relevant activities, then you know you have power. So to sum it up, so to conclude it, when you have power, the first thing you have to ask yourself is that power determined, right? These relevant activities, are they determined via voting rights or complex arrangement, right? And then if they are voting rights, if they are voting rights, there are additional rules. And if they are complex arrangement, there are rules. So firstly is if it is voting rights, so you know these relevant activities are via voting rights, then you know it's easy. All you have to ascertain is whether you get a percentage that's higher than 50%, whether it has control, right? So number one, so firstly, voting rights, if it has potential voting rights. So sometimes they tell you that so you bought this company, then they also gave you shares, right? They also gave you no, you bought shares from this company, they also gave you options, right, to buy these shares. So option is not a share, it's just the right to purchase that share in future, right? Now because you can purchase that share in future, right? Because you can purchase that share in future, it's an option, right? However, if this option you don't have what, look at the definition of power. If you don't have the current ability to exercise this option or this convertible instrument, they'll tell you maybe you're also buying maybe preference shares, maybe convertible preference shares. They can be convertible to equity. That means that you can take those shares and change them into ordinary shares, right? However, if they tell you that it's so they tell you about a date, you have to do it in future, so it's not current, these rights are not existing. That's what it means. These rights are not existing. Do you see that if these options are or convertible instruments are in the future, they are not currently existing, right? So they are not currently existing, and yeah, and basically the entity does not have the current ability to exercise these options, right? So that means that they do not have these voting rights. However, if let's say they tell you maybe you bought shares, right, and you have these options and convertible instruments, and you have the ability to basically change them into ordinary shares currently, then that's what you're gonna do. Intention doesn't matter. So even though they tell you that the entity has the intention of actually converting it 3 years, it doesn't matter if they can change it like this year. So if they have this existing the current ability, right, to change it now, then you also include that portion that they can change to. So let's say I'm giving you an example. So let's say you bought um and it's via voting rights, so you bought 40% of the company, and then they also gave you maybe options, right, options to buy another 20%, right? And those options are currently exercisable. However, you are told that the entity it decides it's going to use these options in the next 2 years, right? Now, I said intention here is not really important. What you have to see is, do we have the current ability, right? And are these rights existing, right? So yes, these rights are existing, and do we have the current ability? Yes, we have the current ability to exercise, right? Even though we are not exercising, we do have the current ability to exercise. So how much do we actually have, like in terms of voting rights or influence? So that's what they mean when they say influence. So they're meaning influence in these relevant activities. How much influence do we have? Voting rights, 60%. Even though we bought 40% of the company, the amount of influence we have is 60%. Therefore, we control the company, right? So even though you're gonna do an analysis of equity, in that analysis, you're still gonna write the 40%, right? Because that's your returns. That's what I'm saying. Returns are different from influence. It's very important to know the difference between influence and returns. Influence, we're looking at this relevant activities, right? So from these voting rights, do you see that your influence like is increased because essentially the entity can at any point in time control this entity. So they have the ability to control this entity. They have the power, right? And then that's the first thing with potential voting rights. So these are potential voting rights. So do you see that they are not yet voting rights because you haven't yet converted it or you haven't yet used the option, right? Then the second one is that the rights must be substantive, right? So like I said, meaning that they must be currently exercisable by the holder, right? Like I said, they must be currently exercisable by the holder, um the and the holder must have the practical ability to exercise, right? So let me also give you another example. So let's say the same example, buying 40%, and they gave you these options, 20% options that you can exercise now. So you can change them now into ordinary shares, 20% ordinary shares to have a 60% stake, right? Meaning that you control the entity, right? However, if let's say your entity does not have the practical ability, right, to actually buy them. So it doesn't have the resources available to buy them. So they do not have the resources. Then that means that that means that you don't have power still. Because why? They don't have the current ability to exercise it because they don't have the practical ability to exercise it at that point, right? So even the entity who's buying, so the investee is also, you also investigate the investee. Like I said, intention is not considered. You just check if they have enough resources really to actually do that thing, né? And then to to convert or to actually purchase, right? And then if it's yes, then you can include them in the calculation, right, of voting rights. And then protective rights must be ignored, right? So protective rights must be ignored. You will see it will be rights that actually protect like the investee, right? I'll give you examples of this later. So that's basically how you determine power via voting rights. So it's very important. This thing, so whether it's voting rights or complex arrangement, you will see it immediately, whether it's voting rights or complex arrangements, right? And then the last thing with voting rights, né? And this is very important. I hope you note this down. This is what they actually like asking, right? So they can sometimes give you, let's say maybe they give you something like, they say you have a 40% stake in the business, right? You see, you have a 40% stake in the business and it is via voting rights. So they tell you that this thing is done via voting rights and you have a 40% stake, right? However, you didn't buy these potential voting rights, right? Instead, they tell you that maybe these maybe two other entities, right? Entity B and entity C, right? Let's say entity B owns 10% of that company and entity C owns 30%, not 30%, 20% of the company, right? So together, B and C, they own 30, right? And A owns 40. So we are A, right? The parent is A, right? And they are buying this company. Let's just call it D Limited, right? Now they tell you that the remaining 30%, so A is 40 and it's 30 from B and C. So the remaining 30%, they tell you that it's held maybe by 10,000 investors, 10,000 other investors, right? So most probably it's traded publicly. So it's held by 10,000 other investors who are not related, right? That's very important. So who are not related, they're just a lot, right? That hold that position, right? Now, what did we say power is? Existing existing right that give the current ability to direct relevant activities. Now let's think about this practically. Ne? When it's via voting rights, like I said, in most cases, you're gonna have to have an AGM, so an annual general meeting in which shareholders they combine, right, and choose these directors, right? Now let's think about it properly. Ne? Obviously A Limited will be there, right? Because it has a big interest in that company, in that entity, right? It will be there in that meeting, right? Entity B will be there alone, I'm sure, in that meeting because it has 10%. It has a lot of interest in that company. So it's also interested in what that company is doing. And then C will also be in that meeting because it has like 20%, right? It has a huge interest, right? However, it's it's basically impractical, right, to think that 10,000 people will actually be there in that AGM, and these 10,000, they like 10,000 sharing 30%, like maybe they own maybe 1% or less than 1%, right? Who would attend the meeting if they own 1% or less than 10%, right? And need I remind you that these parties are all like unrelated, right? Or most of them are unrelated, right? Sometimes maybe they tell you that for all of these unrelated parties, ne, they can appoint someone, ne, but he will only represent 10% of them, right? Something like that. But I'll give you another example for that. For now, let's stick to this example. So 40% of A, and so it's 20% for C and 10% for B and 30% for that 10,000 shareholders. Do you see now these 10,000 shareholders, right? Most probably they are not going to come into the meeting because they're not going to have that much impact, and they don't really, they don't really care like about like the decisions that that company makes. In most cases, those people, they just care about capital appreciation. They just want, is those ones that sell those shares mostly publicly, right? They just want a higher market price for those shares. They don't really care about the operations or wanna be involved in decision making, right? So most probably they won't attend the meeting. Therefore, because we know that most probably they won't attend the meeting, do you see that 30% of the business, right? We know that it won't take a decision, right? It won't make the decision 30%. So because 30% will not be there and you are sure of it, we can remove it already from the 100% and say this entity is over what? 70%. Now, do you see if this entity is over 70%, right? Do you see that entity A actually has the majority shareholding there? So it's the one that has more influence. So whatever entity A says in the end is what's going to happen, right? Because it's going to make a decision, then who's going to oppose it? It's going to be B and C. Even if B and C combined, they only have 30% to oppose A, and those other ones will not be there. Do you see? So which means A does have power over the investee. Why? Because it has the current ability to direct relevant activities. Like I said, this thing is it's very important. This having the current ability to direct the relevant activities is very important, and that's where it comes back to. Ne? And that's via voting rights. Now, via complex arrangements, there are a lot. Like complex arrangements, like I've been giving you examples here, they will just give you the relevant activity, and then you see who controls the relevant activity. So there are no voting rights. You're just seeing who's controlling the relevant activity, right? In fact, on your level, if they give you this one, complex arrangements, it will be simple, right? Because for voting rights, they can still add these potential and the example I gave you before. So let me just give you a final example. So a similar example. So still entity A owns let's say let's make it now 45%. So entity A owns 45%. B and C still the same. B still owns 10. C still it's still 20. And then they tell you that for those 10,000 investors, um, they found a representative, right? But this representative, right, is going to only represent so this is only going to represent like it's going to represent 10%, right? So not the entire 30%. So whatever he agrees on is going to represent 10%, right? Now, do you see that B, C, and that representative, they they accumulate to how much? It's 40%, right? However, A is 45%. Then we know that that 15 it's basically no decision, right? It has no influence in the company whatsoever in terms of decision making. So which means out of 85, so out of 85, you see that A still controls that company D, right? Now, the only way that A does not control it is if, let's say, they tell you that that representative maybe um is representing all of them, so the entire 10,000, right? Now, do you see that these three parties, these three parties is possible for them to come, right? Now, entity A has 45%, right? Entity B has 10, entity C has 20, right? So what does it mean? It means that entity this representative, right, is representing 25%, right? So if it's representing 25%, you see that now, like basically there is no portion of the entity where like no decisions are being made. It's 100%, right? And out of 100%, definitely A does not have a majority share, so definitely A does not control the entity, does not have power over the investor. I mean, does not have power over the investor because you're still determining power. And then for complex arrangements, like I said, it's just entities designed so that voting rights are not the dominant factor in deciding control, right? So you're just gonna decide them using these relevant activities. All right. Okay. And then after you've determined the power, so now you are sure that um you have power over the investee. Like I said here, how many elements are they? Three. So now you've determined power. The next thing is expose. Now these last three, it's nice because once you determine this power, this is the basically the where the majority of the marks come from, right? Here it's just to close it up, right? So now that you have power to what, right? Power to variable returns. Now we have to firstly prove that these returns are variable in nature, right? So it's not something fixed, right? So it's not a fixed payment So these returns, they're not paying you a fixed payment, right? Like for instance, preference shares. Preference shares, they tell you that they're gonna pay you 10% per annum. That's preference. Those returns are fixed. They are not variable, right? They have to be variable returns. And variable returns, it means that basically you have this ordinary interest in the business, right? And you know that a business every year, like year onwards, like their returns, they always change, right? Because you sell maybe more this year, you incur more cost maybe this year, things differ, things differ, like for like things change, like year onwards, right? The economy is always changing, and in any case, even though the economy wasn't changing, these returns were still gonna be variable, right? Because a business's performance from this year on, like year onwards, like it's variable in nature. You can't have the same amount of profit every time. You can have a similar profit, but it's not the same. So these returns have to be variable in nature, right? And then so that's so the investors' returns had the potential to vary, right, as a result of the performance of the entity. Like I said, they vary as a result of the performance of the entity. Now that you've ascertained that these returns, they do vary as a result of the performance of the entity, right? So a normal business, its returns vary as a result of performance. Like I said, the amount on the profit like statement, it won't be the same every year. It's not like if you receive 5 million profit, you want to receive 5 million profit next year. You might receive something similar, maybe you want like 4.9, maybe close, but it won't be exactly there. Like maybe coincidence, yeah, like, but these returns, they have to be the potential to vary, right, as a result of performance, right? So you can actually influence these returns via performance, right? And then that's basically the second one, right? These exposure to variable returns, right? And then the last one is linking these two, right? So you can use that power to affect returns. So not only do you have power over the investee, right? And you are sure that the investee earns variable returns, but actually through that power that you have, you can use that power to actually earn these variable returns, right? So that control that you have, that power that you have, you use it to affect returns. And in most cases, for that, they're gonna give you like 1 mark for that last conclusion, because this is just basically this last element you're concluding. So do you see that the most basically important element is this power, but do not forget to conclude, right? Because that's just losing marks. Yeah. And then that's the scope. That's the scope. After you've determined that, now you know that you control that entity. And when you control an entity, right, you are the parent now. The entity is called the parent and subsidiary, right? So okay, joint control and significant influence, you don't need to do so. We'll come here. So now that we control this entity, right? We figured out the scope. Now we want to know, what do we actually do now that we control this entity, right? I said from last video that the first thing we're going to determine is the level of interest we have in that entity, right? So we know that we control it. Now we determine the level of interest. If the level of interest is 100%, right? If the level of interest is 100%, so it can be 100% in two ways, right? It's either you can buy 100% of the shares completely, right? You can buy 100% of the shares completely, or right, you can basically purchase the assets and liabilities of the entity, right? In that entity, right? So there's two ways to gain 100%. It's either you buy 100% of the shares, or you purchase the assets and liabilities in the entity. So if they tell you that you purchase the assets and liabilities of the entity, just know that that means 100%, right? 100% interest. So that's the first thing, right? Now, if you have this 100% interest, right, there's two ways to account for this, right? It's either you're going to prepare so it's either you're gonna prepare consolidated financial statements, right? So you're gonna be like, for instance, there is a rule in IFRS 10, right? You're still in IFRS 10. There's a rule in IFRS 10, right? That says that the parent shall prepare consolidated financial statements, right? There is, unless something, and there are rules there, right? However, with this 100% interest, now if you have 100% interest, you can choose to account for it via in the separate financial statement, so not in the consolidated financial statement, right? And if you choose to do that, that means that you do not have consolidated financial statements. That's very important to know. You do not have consolidated financial statements, therefore you record it in the separate financial statements of the parent, right? And then what are you gonna record, right? You're gonna record the assets, right? So you're gonna record the assets of that entity and all of the liabilities of that entity. So all of the assets of that entity and all of the liabilities of that entity. So debit the assets of the subsidiary at fair value, right? All of them, and the liabilities, you are also going to credit them at fair value. So basically what you're doing is, like I said, 100% stake. And if it's 100%, so if, let me give you two examples. So if you bought shares, right, and it's 100%, then you have to determine whether that entity prepares consolidated financial statements or it wants it in its separate, right? However, if they tell you that this entity purchased the assets and liabilities, then you know that they are gonna most probably want you to account for these assets and liabilities in the separate financial statements, right? Because even though it's 100%, if they say it purchases the assets and liabilities, they're gonna want it in the separate, right? So no consolidation, right? No consolidation. And then if they just said 100% interest, right? It can be either or, right? They can either prepare consolidated financial statements, or they can also want you to do the same thing. So put in the assets and liabilities of that entity. It depends on that entity. And in the question, it will be clear, right? It will be clear. And then this is basically the general entry you put if there is no consolidation, right? So, like I said, there's two instances where you have control and there's no consolidation, right? Number one, it has to be 100% stake, right? And how is it 100% stake? It's either through shares or buying assets. If you buy assets and liabilities, you have to record it in the separate financial statements. That goodwill has to be in the separate financial statements, right? And then if it's shares, right, there's a choice whether it goes in the separate or there are actually consolidated financial statements. If there are consolidated financial statements, then you won't do this general entry. This general entry here does not exist if they are if like that entity, so the parent prepares consolidated financial statement. If it doesn't prepare consolidated financial statement, so for the shares for that option, it will put in the same general entry it would have put in if they just said it purchased assets and liabilities, right? So the first thing is, if it's 100% and no consolidation, right? So in the separate, you're gonna firstly debit the assets of the sub at fair value. These assets are identifiable assets. So assets that you can actually identify, right? That you can actually see or calculate via those contracts, right? And then you credit identifiable liabilities, right? That term identifiable just means that that entity can actually like it either see or calculate those assets and liabilities, right? It just means that they can find them using IFRS rules, right? And then after you debit the assets of the sub at fair value, credit the liabilities at fair value, and then what happens is you're gonna also credit what the consideration that you paid at fair value. Like I told you last week, the consideration has to be always at fair value, right? The consideration has to be at fair value. But I'll also illustrate via that question. And then what's going to happen is after it's either you're gonna debit goodwill or credit gain on bargain purchase, right? So let's see, when do you use goodwill or gain on bargain purchase? So if now look at this part here, and let me just draw this part of the journal entry. Do you see that this part of the journal entry, right? This part where you debited assets and credited liabilities, this is basically the entire business, right? This is the entire business. This is 100% of the business, right? This is what you bought from the business, right? Right. So let's say here maybe you had assets of maybe 100,000, right? So you have assets of 100,000 and then liabilities of let's say something like 80,000, right? That means that then, do you see now these are the identifiable assets and identifiable liabilities, right? If you say assets minus liabilities is what? Net asset, right? So because these are identifiable assets and liabilities, these are what? If you say net assets minus, if you said identifiable assets minus identifiable liabilities, it gives you what? Net identifiable what? Assets, right? So now you have this net identifiable asset amount of how much? 20,000, right? So what does it mean? It means that on an asset base, like, so if you're just looking at the assets and liabilities of the business, we bought what? 20,000, right? And then let's say here the consideration that we paid, it so in its entirety, it's 30,000, right? We paid 30,000, right, for this deal, right? Now, do you see that what we paid for, right? This 30,000 is actually more, right? It's actually more than the assets, right? The net identifiable assets, right? And like I explained last week, right? Like in a business, right? It's so for a business to operate, it's not only those identifiable assets, but there's also an asset, right, in a business called goodwill that's not identifiable, that you can't see, right? So it's the synergies of how those assets are working together, right? And that also has a value, right? Like I gave you that example where I used those internet cafes, right? That even though they have the same equipment, they might not be generating the same returns. And as a result, when an investee sells a part of that, maybe internet cafe, like he might sell it for more, right, in a particular area than he would have in another area, right? That's because the goodwill, the synergies between those assets are good. So that means that 30,000, and I implore you to also go to that part of the video if you don't understand this goodwill part, right? I did go in detail in terms of like explaining what this goodwill is. So now this, obviously you purchased what, 20,000 using this 30,000. Now it's gonna be 10,000, right? Difference, right? Do you see that? What do you have? You have this 20,000 debited, right, in the assets part, and then this 30,000 credited, right, in total, right? So what's left? You are left with a debit of, you have to put in a debit of 10,000 so that these general entries they balance, right? That's where this goodwill comes from. You're gonna say debit, goodwill, 10,000, it's the asset. So this 30,000, what you purchased, 20,000 of the net identifiable assets and 10,000 was for the goodwill, right? Now, second example, let's say here you didn't use 30,000 to buy this business. You actually bought this business for, let's say you bought this business for 15,000, right? So you bought it for less than its value, right? Because its value is those net identifiable assets, right? Now, if you bought it for less than its value, then do you see that then at that point in time, so at that date of acquisition, you actually made a profit, right? Do you see that you actually made a profit because you bought it for less than those assets are actually worth, right? So you made a profit. And that profit, what do you do with it? You credit. So you're going to credit gain on bargain purchase. So you're going to have this 20,000. So you 20,000, don't forget, is the net, right? Because here you have 10,000, 80,000, which gives you this 20,000 difference for the debit side. And then you have this consideration for 15,000. We still have to credit another what? 5,000 of this gain on bargain purchase. And this is a profit for that year, right? The profit for this year, that year. So that at that point where they acquired the business, right? And that's what you're gonna have in the separate financial statements, right? If what? So in the separate financial statements, if number one, it has to be 100%, and they tell you that you purchased assets and liabilities, right? Then you can also do this. However, this I think, okay, but for on your level, yeah, they might ask it. However, what they like consolidation because most businesses consolidate, right? So now we're gonna move on. So now we're coming here. So like I said here, first thing you have to determine this 100% interest thing, right? Let's say the business, it's not, so you didn't buy the assets and liabilities of the business, and you bought a stake lower than 100%, right? Which is not like what normally happens, right? You buy a stake that's lower than 100%, right? And you've ascertained, right, using these rules, the scope, right? You've ascertained that you have control, because this thing, what, so here do you see we're already at implication. So we've already determined that we are controlling that entity, right? Now, if it's any other percentage, then the parent shall prepare consolidated financial statements, right? What does it mean? It means that in the separate financial statements, right, of the parent, right? Because it's very important to know separate and consolidated. So now we are still in the separate. So normal statements of the parent. What's going to happen is we are not going to record those assets and liabilities, right? You are just going to have this investment in B, right? So this investment in subsidiary, right? Why? Because we took out consideration, right? So we are just going to say the consideration that we paid, right? So do you see in this one, we do have the consideration. So this consideration here and the consideration here is exactly the same. Ne? However, do you see here, it's when there is no consolidation, right? So goodwill is in the separate financial statements, right? Then here is a normal one where there is consolidation. And here, don't forget this 100%, here normal, right? So here you can also be here when you're 100%. However, like that's if like you bought like maybe shares, they say you bought 100% shares, you can also have a choice to consolidate, right? And that's what mostly happens. So this is what happens in the separate. So the parent is going to take the consideration at fair value at what date, fair value at acquisition, and then debit the investment in subsidiary, right? That's what it's going to do in its separate financial books, right? And then now we are going to the consolidation process. So like I said, separate books, that's for the parent, right? Now we are going to consolidation. So consolidation means from a group level, right? Consolidation, now we are going to account for this on a group level, right? What's happening, right? So the first thing you have to know, ne, and I'll also illustrate it again, is that the reason why we do group accounting is to go from combined, right? Like I said last time, so it's to go from combined, right? Combined journal entries. So from combined to what? Consolidated, right? Consolidated, right? Right? Consolidated, right? So this process here is the consolidation process. And after you have your consolidated financial statements, right? And then how do you consolidate? You consolidate via these journal entries called pro forma, right? Pro forma, so pro forma journal entries, right? So call these pro forma journal entries. And what do they do, these pro forma journal entries? They do two things. They fix the discrepancy between um, what happened on a group level and on a combined level, and they allocate non-controlling interest, right? Allocate non-controlling interest. Like I said, what happens on a separate level and on a group level is always different. So these pro forma journal entries, they just fix and allocate, but in most cases they do this, they fix. But I will also show you when you allocate. These allocation journal entries are a lot, so they are not as many as these like fixing journal entries, right? So now with consolidation, we now before I come to this, so what do I mean here when I say it's looked at from a group level, right? So when you look at entities from a group level, you are treating those two entities as one entity, right? That's what I mean when you say we look at things from a group level. You're going to look at and treat it like one entity. That's what we mean when you say consolidation. You're going to treat it as like one entity. Like I gave you an example, I'm going to do it again because I feel like it's very important for groups to know this is the main reason why you're doing groups, right? So let's say you have this A, like we said, is the parent, right? And we have B, right? If A sells to B, right? A is going to have journal entries, right, to record. So A is going to record journal entries, right, because it's selling to B, right, an entity outside it, right? And then entity B is going to record this transaction, right, in their separate, right? Because in the separate financial statements, these two entities, they are not related. So from a separate point of view, these two entities, they are not related, right? So what happens is that A, so it transacts with B. So let's say it it sells inventory to B, right? And then it'll record that sale, then B will record that purchase, right? But let's look at what happened from a group level, right? From a group level, right? So this is the A group, right? Because groups are always named after the parent, right? So this is the A group. So from a group level, what happened? Nothing. Do you see that nothing happened from a group level? Because these two entities, it's actually one entity, right? So nothing happened. So what we do here, what I mean by combine is that starting point, what's going to happen? When you consolidate, we consolidate every time you consolidate at the end of the reporting period, right? When we consolidate, the first thing you're gonna do is, that's why they say the starting point. The first thing you're gonna do is you're gonna add 100% of the subsidiary to the parent, right? And when I say 100%, I mean everything: assets, liabilities, all statements. You're just gonna add everything, right? And then now, when you add everything, do you see that, let's say a transaction like this happened? Do you see that you are saying that this transaction happened, right? And we are wrong. This transaction didn't happen. So what must we do? We have to fix, right? We have to fix this transaction, meaning basically eliminate this transaction from happening, right? Because from a consolidated level, this transaction didn't happen. So therefore, we have to eliminate this transaction from happening, right? That's what I mean when I say fix. And that's why we fix here, because of the starting point. So it's very important to know the starting point, right? That you're adding 100% of the subsidiary. And as you go on, you're going to fix, right? And then what do we do when we start, right? Now, starting point, like I said, this is the combine. And do you see that these combined channel entries, the starting point, you don't see it anywhere, right? Why don't you see it anyway? Because in most questions, they're going to ask you, prepare pro forma channel entries, right? Now, like I said, pro forma channel entries are what? Are they to fix and allocate? When you are doing these combined channel entries, are you fixing and allocating? No. You are just adding the parent to the subsidiary. That's why it's not a pro forma channel entry, right? And then, right. So let's start. Right now, you've added both of them together, right? Now, before I move on, I just wanna go back here, right? Now, remember I said these assets and like these liabilities have to be at fair value, right? Now, you do realize, right, that here, right, the subsidiary will not record all of its assets and liabilities at fair value. And yeah, it will not record all of its assets and liabilities at fair value, right? Because there are different models, right? Like for instance, most of PPE uses the cost model, right? Right, or the diminishing balance method, or but some depreciation model, right? But it doesn't use fair value if it's PPE, right? Do you see that they are actually assets that don't use the fair value model, right? Now, do you see that from starting, so at acquisition, when we just added these assets and liabilities to the parent, like of the subsidiary, the first thing is that these assets, like even at acquisition, these assets they are incorrect, right? So the first thing is, and do you see where do we start? At acquisition. So where are we? Even in your mind, you have to think of this perspective. Where are we? We are still when you're acquiring the business, right? So even when you're acquiring the business, this thing is still at the carrying amount, right? Maybe let's say it's at cost, right? Now, if they tell you that, let's say maybe the PPE maybe was worth something like maybe it was worth 80,000, right? And they tell you that um if so you can sell it in the market for 100,000. So the market value of that PPE is actually 100,000, right? So do you see that the market value is different from the carrying amount of the asset at that point at acquisition, right? Because of that, we have to adjust the carrying amount of the asset. If you are just doing this one here, it wouldn't matter, right? Because there's no consolidation. It's not like you're consolidating. So here you are just gonna put in that asset at 100,000, right? You're just gonna put in that PP at 100,000. But the thing is here, you already added that 80,000 here, right? You already added it here at acquisition, right? So the first journal entry we do is called these fair value adjustment journal entries, right? We have to adjust these fair values because what does IFRS 3 business combination say, right? IFRS 3 business combination, it says that the net assets and liabilities have to be recorded at fair value, right? At fair value. So in that example that I gave you there, what's going to happen is that we are going to say PPE, we debit with 20,000. Now, you are still in second year, right? And even in that video, please ignore everything I say when I talk about deferred tax. You guys don't do deferred tax, right? So ignore everything I said about deferred tax. So what you're gonna just have is this journal entry of land, right? Or the PPE you debit, and then equity at acquisition you credit, right? Equity acquisition you credit. And in this case, what does it mean, right? This equity acquisition, it basically means something like profit or loss at acquisition, right? Because imagine it like this entity, this subsidiary, it thinks this PPE at this point is worth 80,000, right? However, it's actually worth 100,000. So in their discrepancy, you made basically a profit, right, of 20,000. So you have to record, increase your PPE amount, because don't forget this PPE amount was actually 100,000, not 80,000. So increase it by 20,000 and then credit equity at acquisition with 20,000, right? That's the first thing, fair value adjustments, right? And then don't forget that there are some assets and liabilities that might not have been recognized, right? Yeah, might not have been recognized because of IFRA's rules, right? However, during a business combination, there are some rules that are pardoned, right? So there are some rules in accounting there. So there are some rules that don't apply the same, right? Like for instance, with intangible assets, right? As long as you can identify the intangible asset, right? You know, it doesn't need to meet the recognition criteria, right? You can just record it even though it meets the identification criteria, right? Yeah. However, I think for all of those small details, like for instance, even with this one of the consideration, I think I'll just make a list and send it, right? Because today basically we are summing up group statements, right? And then now those adjustments. So let's say in that case for I'm talking the intangible asset, right? So let's say they tell you that the intangible asset was not recognized, right, in the subsidiary. So in the subsidiaries, for that intangible asset, you don't have anything, right? However, now you can record it because it says it's IFRS 3 business combination rules that that intangible asset, even if you can identify, if you can just identify it, you can recognize it, right? And there are other rules, even for contingent liabilities. Contingent liabilities are recognized for business combinations. So there are rules there other than fair value adjustments, right? And then what happens is that intangible asset, like I said, there is zero here, right? Because it's not recognized. Here they tell you can recognize it. So you're gonna say debit what the intangible asset actually recognize it, right? And then what do you credit? Equity at acquisition, right? Right. Even with something, let's say like a contingent liability, because contingent liabilities they are recognized, right? Contingent liabilities normally according to IFRS rules, subsidiary does not recognize contingent liabilities. Contingent liabilities are only disclosed, right? And you'll see I'll be using these terms: disclosure, presentation. I implore you to go to last week's video and at least 10 minutes, right? That first 10 minutes we actually speak about perspective, right? That's very important, especially for group statements. Once you have that, like it'll never you will never fail group statements. It'll be one of the easiest, right? Because it's only perspective that people are getting wrong here. And then with, like I said, with, let's say you have like a contingent liability, right? Contingent liabilities, like I said, they are only disclosed here, they are not recognized. However, business combination said you can recognize it. So recognize it, you're gonna say credit contingent liability because it's a liability, and then what? Debit equity at acquisition. You guys do not even consider this deferred tax, same amount, right? So don't consider deferred tax. And then after you are done with these adjustments, right? These adjustments, right? Now please start preparing your analysis of equity, right? At this point, start drawing your analysis of equity, right? Because with this analysis of equity, it's going to help you actually have like, it's going to help you with calculating those, also with the measurement. So the measurement part, so the calculation part of the pro forma journal entry that are about to come, right? And then now, we are here, right? So after we're done with this, we're going to main elimination journal entry. So basically recognizing goodwill and gain on bargain purchase. And I'm still reminding you here that what happened is, firstly, when we are at the scope, when you are here in control, where were we? We are still in IFRS 10, right? Control. So control is in IFRS 10. Now, when you are looking at implication, right? When you're starting with, so when you are done with control, right? Now that we know that we control this entity, the first thing you'll see, I haven't really delved deep into IFRS 3 business combination, right? Use their method, right? Because they're telling you, firstly, you have to use the acquisition method, identify the acquirer. They're gonna tell you all of that, but all of that is really simple to determine. Like for instance, determining the acquirer and even the acquisition date. Those are all simple things. The only thing that you have to determine, like before you start with business combination, so this IFRS 3 is firstly to check that they did control, right? So you do control the entity. And then secondly, how many assets and liabilities did you buy in that entity, right? Make sure that it's the same contract, right? So if let's say they tell you that you bought a business, right? Let's say something like, yeah, an internet cafe, right? And then let's say even in that contract, so in that contract, included maybe was let's say in that contract, maybe included like was something like maybe a bicycle, right? And that bicycle is not really used in the business in any way, right? So do you see that that asset is not a part of the business? So it's important to know here what's also a part of the business. That asset, that bicycle is not a part of the asset, so it won't be in their net asset value, right? Because it's not a part of the business. So it's very important to know also what's a part of the business in business combination. And then the third thing is, it's very important to know that you are actually running a business, right? So there's some input, some processing, and then some output that's being sold, right? Then you can start with business combination. So firstly, you control them, right? You control those assets and liabilities, and then how many assets and liabilities are actually in the business, and then is it actually a business? And then after, you can start here with this business combination and all of this implication I've been talking about. So meaning I ended on IFRS 10 when I ended with control after I've been doing business combinations. And that was what I was discussing. So for the last 4 minutes now, it's just the identification for business combination, right? They might ask you questions like that, but they don't come up very often. And even if they do, maybe it's something like 10 marks. Yeah. So this is still business combination. Yeah, this part that I'm doing, the implication part now, this they love. Yeah, this they like. I don't think there's actually a question where you won't have the main elimination journal entry, right? or some sort of journal entry where there's goodwill, because they have to test the goodwill, right? And then, so like we said, here we're dealing with fair value adjustments, right? And then do you see that with these fair value adjustments, now we adjusted these assets and liabilities, right? Do you see that at acquisition, what happened? We've now adjusted these assets and liabilities to look proper, right? From a group level. Like I said, we adjust these things to look proper from a group level, because from a separate level, like I said, the subsidiary saw that PPE as 80,000, right? But from a group level, it was actually 100,000. So do you see now, because we've adjusted them from a group level, those assets and liabilities at acquisition, so at acquisition date, they are okay, right? So because they are okay, now what do we have that's new? We have this balance, right? This equity at acquisition, right? We have this new balance, which is equity at acquisition, right? And then for your analysis of equity, even in the last session, I showed you basically how it looks. Please go to that session and see how it looks. This equity acquisition will also be in your analysis of equity, but I did speak of it intensively in last week's session. So please refer to that. And then now we go to this main elimination journal entry. And do not forget, the reason why we do the analysis of equity itself, it's not worth a lot of marks. We do it why we do it for the pro forma journal entries, right? Do not forget the objective why we do things. So now we can continue. So it's main elimination. So the main elimination journal entry, how basically is it going to look? So firstly, do you remember that at the starting point, what happened? We added 100% of the subsidiary, right, to 100% of the parent, right? And then we fixed all of those fair value adjustments and basically those discrepancies at acquisition, right? Now, what's left is that now those first journal entries that we did, these ones are the first pro forma journal entries that we do. Do you see why? Because they actually fix, right? Like I said, pro forma journal entries, they either fix or allocate. So these ones are pro forma journal because they fix. Let's come here. So even this is the next journal entry you're gonna do. The next pro forma journal entry you do is the main elimination journal entry. Like I said, 100% have been added, and we fixed it. We fixed those adjustments at acquisition, right? Now, what is the main elimination journal entry? It's exactly what it says. It's going to eliminate, right? It's going to eliminate some items that have to be eliminated, right? Because from a group level, they don't make sense, right? So what's it going to firstly eliminate? Firstly, you're going to eliminate all of the equity from the subsidiary, right? All of it, all of the equity of the subsidiary, we are going to eliminate. Why? At acquisition, all of the subsidiary of the so all of the equity, right, of the subsidiary at acquisition, what are we going to do? Eliminate, right? That's what you're going to do first. Why? Right? Why? Because of this principle, you cannot invest in yourself, right? Like I said, those two entities now, entity A and B, they are the same entity, right? And it's very impractical to have like equity in here, right? You can have assets and liabilities, but not equity, right? You can't invest in yourself, right? So first you're gonna debit all of the equity, and I mean on retained earnings, share capital, market to market reserve, every reserve that they have on equity, you debit, right? Including what? Including this equity at acquisition, if you have a credit balance of it. So you see here, it's a credit balance. Sometimes the equity acquisition is a debit balance, but if it's a debit balance, obviously here you're gonna credit because you have to remove also that equity acquisition. So for this equity part, do not forget to also remove the equity acquisition here in the main elimination journal entry. So do you see what does this mean? It means that if you forgot about these fair value adjustments, right? It means that you would have forgotten about this equity acquisition, and that means that this journal entry is going to be wrong because it doesn't have that equity acquisition, like where you eliminate the equity acquisition. So you have to record it and then eliminate it, right? And then what? That's the first thing you do, the equity. And when you're doing that, right, you see that that's the value of the business, right? Why is it the value of the business? Because assets, right? What is the value of the business? so when you are here, when we were here, let me show you when we were here, right? We said assets minus liability is actually the value of the business, right? Now, assets minus liabilities, what also is it equal to? Is equals to equity, right? So equity is also the value of the business, right? So do you see that actually the equity that we would have eliminated here is the value of the business, right? This is the value of the business, right? And then what happens is we create what? The investment that we have. We have this investment in B, right? Don't forget that we got it from this journal entry here in the separate. Because I said when you have consolidation, we're gonna have this investment in the separate books, right? This investment. So we're gonna credit this investment. Why? Because you cannot, like I said, invest in yourself, right? And you see that this investment amount actually is the consideration, right? Because when you are here, you actually credited the consideration, right? So it's the amount of the consideration. So we have the value of the entity here, the amount of the consideration here that you paid, right? However, don't forget that you don't own the entire portion of the entity, right? You don't own the so all of this equity is not yours, right? So the first thing we want to do is we want to attribute some of this equity to the non-controlling interest, right? So let's say the non-controlling interest maybe was like something like maybe 30%. We want to attribute the 30% to non-controlling interest. So you're gonna say that equity multiplied by 30%, but only if they tell us that the non-controlling interest is measured using do you see proportional net assets and liabilities. So the net proportion of assets and liabilities, if they tell us that they're using the net proportional, then you just take this equity multiplied by the percentage of the non-controlling interest. So non-controlling interest is the other one. If you have a 60% interest, then the non-controlling interest is 40% because they do not control the business, but they do have an interest in that business. And I did explain all like how equity is funding and liability is also funding. Please refer to the video. It's also like important in understanding this, right? And then, like I said, the non-controlling interest can either be measured via this proportion of net assets. So the first thing, when I have this equity, then just take this equity, multiply it by the non-controlling interest percentage. That's for the net proportional assets and liabilities method, right? Or the non-controlling interest can be measured via fair value. And with the fair value, they will just give it to you. They will say the non-controlling interest is measured using the fair value, and they will give you the fair value. However, sometimes they can say the non-controlling interest is measured using the net proportional assets, right, and liabilities. And then they say, however, the fair value of the non-controlling interest is maybe this amount. Do not be fooled, right? Because they said they are using the net proportional assets and liabilities. So even though they gave you the fair value, do not forget that you still have to take the equity and multiply it with the percentage of the non-controlling interest. It's very important to know the policy that they are using, especially in these or statements, because they can use either or, right? And in the question, they might put these things just to trick you, right? And then I said, here is the investment. So do you see that now that you have the equity, this is the entire equity of the subsidiary, right? You've removed it, right? Eliminated it, and this is a pro forma journal entry, right? Because eliminating it, you're actually fixing it, right? To make it look like from a group level, to make it basically consolidated. And then here, what did you do? You allocated, right? Which is also part of a function of the pro forma journal entries, right? And then what did you do here? You fixed, right? Because here you eliminated this investment, which obviously you cannot invest in yourself. And then here I said this is the entire value of the entity at this point, right? Minus what? This non-controlling interest, right? So what is this non-controlling interest? Like I said, is the interest that belongs to other shareholders except you, right? So what you're gonna do is gonna attribute that equity, and this equity, don't forget, is the equity where at acquisition, right? Attributed to the non-controlling interest. Now, what's left? What's left is your equity, right? After you minus this non-controlling interest, right? You agree it's your equity, and what minus this investment. And what is this investment? This investment is actually what you paid, right? It's actually what you paid. So that's what you minus the right. So That's what you minus did. It's what actually what you paid. And exactly like that journal entry we did, right? If let's say the equity here was maybe 100,000 again, maybe let's say, and we have an interest maybe of 60%, right? And then they said the non-controlling interest, they use the proportional net assets and liabilities. What's going to happen for NCI? We are going to have 40,000, right? So that means that the accumulated value that basically we have that's still left is 60,000, right? Let's say here we paid something like 70,000, right, or 80,000, right? Do you see that it's more than the 60,000 that's actually attributable to us, right? What's going to happen is that amount that's left, that amount, so because it's 60 minus 70, that 10,000 is left, you're gonna debit what? Goodwill with that amount, because you actually paid more than the value of the company, and what you actually paid for is the goodwill. And then if it's less, you know that you got a gain on bargain purchase, right? So it's gain on bargain purchase. You have this credit gain on bargain purchase. And then that's basically the second set of journal entries you do. The first set is those fair value adjustments, and secondly is the main elimination journal entry, right? So that's the main elimination journal entry. And as you can see, it is a pro forma journal entry. Like I said, they were fixing and allocating here. Then we move on then. So after you've done with the main elimination journal entry, you've basically recorded everything that you fixed, basically everything. You fixed and allocated everything at acquisition, right? So at the date acquisition, you've fixed and arranged everything correctly, right? What's left is now from since acquisition, right? So what happened since acquisition, right? And what happened like since acquisition? The first thing that happened is, right? The first thing that happened is, don't forget those assets and liabilities, these ones, right? These ones, right? Don't forget that the subsidiary still thinks that it's 80%, right? It's 80,000, I mean. So what does it mean? It means that the depreciation for that PPE will be lower than it actually has to be, right? So therefore, you have to fix those discrepancies for these ones, these adjustments. So all of these adjustments, you have to look at like subsequently how you have to fix them, how you have to look at them from a group level. Mara, I will show you that. And honestly, on your level, they like playing here too much at acquisition, right? And then the last one is fixed also other discrepancies of what happened in the future. So, like I said, if let's say the parent sells to the subsidiary, right? So those intra-group transaction, fixing them also, and then after fixing them, it's allocating the rest to non-controlling interest, right? And then that's basically um the whole run-up of groups, right? Um, for this session, I didn't actually want to go here in detail, although you are taught even this part here, right? If you want more information on this part, because I don't think next week we're gonna do accounting. Next week we're gonna continue either with finance or tax. So um with this one, if you wanna see this part, um this part how it's actually done in detail, right? Because they might ask it maybe they might ask it, right? So I'm going to do this part for become third years, right? Because they actually have a question that I have that actually talks about this part. They may ask you this part, but I think it's going to be somewhere near the exams, right? However, they can even ask it now if they have taught it, right? So if you wanna want more information about how what to do from since acquisition, then I suggest you watch that video that I'm gonna upload for the Become third years. You can just watch the since acquisition part, right? And skip the at acquisition part, because from since acquisition, it's going to be the same. The way the become third years do it and second years is exactly the same, right? It's only the ad acquisition part. No, it's actually you guys are doing it the same actually everywhere. It's actually this deferred tax, right? So every time I talk about deferred tax in those videos, do not just ignore me, because you guys are not doing deferred tax. Otherwise, everything remains the same, right? And the fact that you guys are not doing deferred tax is actually easier because you don't have to remember deferred tax, right? And then so that's basically it in terms of the slides that I wanted to do. Now let's go to the question, straight up question, and see how do you apply this knowledge now in the question. So the first type of question, so let's start. So while you're doing the question, I'm gonna show you how to apply the approach, right? So firstly, it says be limited. Now, do you see? Firstly, it says be limited. When we were at the approach, right? What did we firstly say? Perspective, right? Who are you, the person? So they have listed an entity here, which is be limited. So you have to write be limited somewhere and see if we are be limited or what entity we are, right? So they tell us that B Limited owns 50% of the shares of A Limited. So there's B Limited and A Limited. Those are the two parties, right? And then they said a listed company. So a listed company with more than 20,000 shareholders. So they tell us that this entity A, right, is also a listed company with what 20,000 shareholders, right? And then only one shareholder holds more than 1% of shares, right? And they tell us that this entity is entity C, right? So what do we know, right? So we know that we have B, right, who owns 50%, right? So we have B who owns 50%, right? And we have C, right? C who owns 10%, right? Okay. Those are the ones that we can see from still, right? And they tell us that each share entitles the holder to um entitles the holder to one general vote at the annual general meeting, right? So do you see? I said the first thing you have to ask yourself when you're doing control is what? Is whether you are what? It's a voting right situation, right? Or complex arrangement, right? Do you see now they're telling us that each holder is entitled to one vote at general meeting. So which means this is via voting right. So you just need to know the percentage, right? We need the percentage majority, right? We know that. And then it says the relevant activities are directed by the annual general meeting, right? So it's through the annual general meeting. Do you see? Now they talked about these relevant activities, right? Now we know basically. So this is the entire basically scenario for scenario one. What do we know? We know that B owns 50 and C owns 10, right? Yeah, C owns 10, right? And then what happens? What happened to the remaining 40%? Let's talk about this remaining 40%, right? Right? They say this remaining 40% is held by the rest of these shareholders, right? 20,000 shareholders, right? And each shareholder of these 20,000, right? Only they tell us that only one. So even here, so all of these people, this 40%, there's no one who actually owns even more than 1%, right, of the company, right? It's all like they told you, C is the only one that owns 10% other than B, right? Now, as you can see, this 40,000, what does it mean? And they didn't tell us anything about a representative that's going to represent them, right? It means what at this meeting, what's going to happen, right? The only people that are going to attend this meeting every time is going to be B and C. Do you see? B and C, right? It's going to be B and C, right? Because this 40% actually does not have decision making power, right? No influence. That's what it means. That's why they say degree of influence. It has no influence in decision making, right? So let's look at the influence of decision making is 60% in total, right? This is the percentage of the company that can actually make decisions, right? And B has how much of it? It has 50 out of that 60%, right? Now, if you say 50 divided by 60 times 100, you will see you get more than 50%, right? So 50 divided by 60 times 100, you get 83%, right? So do you see that entity B actually controls entity A, right? Because we know that this 40,000, they will not vote, right? So the vote will only be here on the 60%, right? And we own 50, right, of the 60%. So um it controls the business, right? um Hope you got me there. So let's just see what they said in the scenario. Like I said, yeah, like I said, this definition has to always be there. Now I didn't even read this, the required. Yeah, we have to read the required. So the required said, based on the two scenarios presented above, discuss whether B has control of A and D, right? So yeah, that's the question. And then, like we said, okay, here, so they said B owns 50% of A. Now, do you see that when they say B owns 50% of A, right? What does it trigger? We know that what B is actually it B actually bought shares from A. So you know that you're doing group accounting, right? B bought shares from A, right? And then now we want to scope it, right? We want to scope it. So we know that it most probably is group statements, but we are not sure, right? Most probably it's group statements, or you're not sure. So you have to first determine whether Vele it's group statements with control, right? We said we determine firstly the level of influence. Do you remember here, the slide here that we started with here? We said when an entity buys a stake in another entity, then the first thing that entity A will do is determine the degree of influence it has. And how do you determine the degree of influence? Firstly, by determining whether control exists, right? And how you determine whether control exists? There is a specific definition for it, right? And I said that definition, you have to write it down like they did here. Do you see? Suggested solution, they wrote it down. Look, you got 3 marks just for writing down the so just for remembering the definition, you got 3 marks, right? And then now actually applying the definition, right, is what we're doing here, right? So they were only, do you see that this question was only asking the scope, not the implication? They were asking the scope, whether this thing value control exists. They're actually asking the scope only, right? So meaning use the definition to actually see whether this thing value does abide by IFRS 10 rules, right? So let's see, right? We said, so we said it only controls an entity when it has what power over the investee, right? And we said power is what? Power to direct relevant activities. And we said this power is directed via voting rights, not complex arrangements, right? So they said A Limited can exercise power through its 50% shareholding, which gives it 50% of voting rights, right? And then the relative size of other shareholders' interest gives A large enough dominant voting right to meet the power criteria without the need to consider any other evidence of power, right? So you could have written an answer like this, or you could have given an answer like I gave, like that specific answer that um the in so basically the 40% of the shareholders that are left, right? Because they hold more than less than 1% of the shares, right? That means that the probability of them actually coming together, right, and forming a unit, right, forming something like a unit to oppose B, like that's not possible, right? Because it's 20,000 of them. That's not possible, right? Because it's not possible, right? It means that the only people that have decision making power, right, is B and C, right? And B has more decision making power than C, more influence than C. That's what I mean when I say decision making power. Because B has more influence than C, right? B controls A, right? So if I can repeat, so let me repeat. So the first thing you say is what? The 40% representing the 20,000 shareholders, right? With less than 1%, right? That 40% has no influence on A, right? Because it doesn't influence these relevant activities, right? Right. And then B, it has it has a significant influence on this basically entity, right? And also C, it has a big influence on this entity, right? Now that means that the only percentage that you have to influence decision making is 60%, right? B uses more. So B has more influence in that regard, right? That means that B actually controls what? A, right? And then don't forget the fact that the returns have to be variable in nature and linking them up. You'll see in this question they didn't do that, but always do that. Like learn to complete questions, right? Yeah, always do that because you don't know if they're giving you marks for that or not, right? Because in questions, then this is basically a tip for varsity and basically for accounting. Um, they're gonna have like maximum marks, right? Maybe maximum, maybe they have something like maybe 30, right? But the question maybe was out of 20 or 25, right? So what I'm saying is there's not there are a lot of places to get marks. It's not limited. So like span your answers as far as you can, right? And then um let's go to scenario two. So scenario two says B holds 48% of the issued share capital of D, right? And then it says Mr. Sahal owns 27% and Ms. Kekana owns 25% of the shares of D. And they said each share entitles the holder to one voting right, right? So do you see that this is via what? Voting rights, again, not complex arrangement, right? And then they said the articles of association determine that decisions relevant to the activities of D are made through a majority voting, right? So it's via voting rights, they tell us straight, on the annual general meeting, right? And then D has no other classes of issued shares, right? And then no other arrangements exist that could influence decision making. So we know that decision making is only influenced via these voting rights, right? So we don't have a complex arrangement, this is voting right. And then what happens is now we have to look at our parties, right? Firstly, we have B, right? B owns this 48% stake, right? B, right? And we are B, right? We own 48%. And then we have Mr. Sahal who owns, so just call it Mr. SA. So Sahal who owns 27%, right? And then we have Ms. Kekana, I get Ms. Kekana, okay, who owns 25%, right? So now let's see this. Let's look at this. Are there any investors they don't have the practical ability to attend? All of them, do you see they have the practical ability to attend, right? They have the practical ability to attend, right? Because they can all attend is not the situation, right? So what do we do is 100% of them can make the decisions, right? It's not only limited maybe to 60%. Because 100% can make decisions, B only holds what? 48%. Whereas if Sahal and Kekana owns 52%, so more than B, right? So which means they can outcompete B in terms of decision making, right? So B can come up with a decision, but these two can agree to a decision and outcompete B, right? That means that B does not um, have control, right, over the relevant activities, right? It does not direct relevant activities. And because they do not direct relevant activities, um, B does not have power over D. So B does not have power over D. Therefore, B does not control D, right? As you can see here, the size is related. So the size of B's voting rights relative to other shareholdings are sufficient to conclude that B does not have power over D. However, the other two investors would need to cooperate to be able to prevent D from directing relevant activities, which is possible. Do you see what I mean? It's all about relevant activities when it comes to control most of the times, right? Because they ended power. But when you're explaining, when they say just control, so if they don't specify power, please do not forget about the returns, the variable returns, and the link between the variable returns, right? And then that's basically the scope part of the question. That's how it's done. Now we can move on to another part. So this is the second question. So the question you're doing, it was question 1 of 2019. The fourth test, it was, yeah, fourth test of 2019. And then now we are doing oh, it was a second question. Now we are doing question 1 of the 2019 test. So okay, let's read the scenario. So it says Electrolytes Limited, a well-known company that manufactures various kinds of light bulbs. So Electrolytes, we are the company, right? Perspective. And then during the past 10 years, Electrolyte has grown from a small business to a well-conglomerate, right? And they tell us that on 1 January 2019, Electrolytes so expanded its operations by buying all the assets and liabilities of Fantasy Lights, right? So do you see that January 1 January 2019, it's a date, right? And that date is significant. Why? Because it's a date of acquisition, right? Where they actually acquired Fantasy. And how did they acquire Fantasy? Via assets and liabilities. Now, don't forget, what did we say? We said um, if we see an entity buying into another entity, so buying a stake into another entity, the first thing you have to determine is control, right? Now, because Electrolyte is buying the assets and liabilities of FNTC, that's not really necessary because we know that they definitely do control the assets and liabilities. And because it's assets and liabilities, what did we say? It's 100% stake, right? But because they said they purchased the assets and liabilities, is there gonna be consolidation? No, right? So they don't. In most cases, they don't plan to consolidate unless they tell you prepare consolidated financial statements. Then you know they do consolidate, right? But here, if it's assets and liabilities, then you know that most probably they are not going to consolidate, right? And then they said through a business combination, okay? And then so we know basically that so we know the scope control. So where are we in the MM approach? So we already got the trigger, right? Already saw this, right? And the scope, we already know that that entity controls that entity, right? So we are here. Do you see that this question is going to be focused with the implication, right? The recognition part and the measurement part, right? You can already see that even without reading the question. So without even reading the required. And then the document is an extract from the acquisition agreement between Electrolytes and the seller, right? So acquisition agreement here is they said Electrolytes will purchase all the assets and liabilities of Fantasy Limited, right? Now, if it's implication, right, you're already in implication. What I told you last session, so in that video, is that you gotta have a timeline, right? Because you can't keep track of all of this information. So we started at acquisition, right? This is at acquisition, and we know that at acquisition is 1 January 2019, right? So this is when we acquired the assets. So we acquired the assets and liabilities, right? And we know that most probably it's going to be in the separate. So most probably in the separate, we are going to record the goodwill, right? So in the separate financial statements, we are going to record the goodwill, right? That's most probably what's going to happen. And then um, they said, okay, Electrolyte will purchase all the assets and liabilities of Fantasy Lights. The purchase consideration will be settled as follows, right? They said 12,544,000 will be settled in cash, right? The amount will, however, be paid in cash on 1 December 2020, right? So, okay, we've been going through all of this, but what's more important is this financial year. So, um, okay, they didn't tell us anything about this financial year, so just gonna plot the dates. So let's say here it's the 31 December 2020. Okay, now let's not put it here. Let's put it even further. Okay, so 31 December 2020, right? That's basically 2 years after the date of acquisition. Do you see that's when the cash will be paid? This 12 million, that's when it will be paid, right? Then they said the amount will be paid. Then a market related rate is available for electrolytes for financing purposes, right? So we know that here we have the cash payment. So when you are busy reading the scenario here, that you always write on your timeline, right? So here, just so that you don't forget that here we're expecting that cash payment, right? Just that it's hard here to illustrate with this mouse. And then electrolytes will settle the remaining part of the purchase through an issue of shares, right? So this is the don't forget, we are talking about the consideration here. This is the consideration. Electrolytes is they're telling you how will it be settled, right? So with the issue of what 60,000 shares in electrolytes to Fantasy Limited, right? On the date of the transaction, the shares had a fair value, right, of um 20 rand per share, right? And then they tell us that the electrolytes will transfer a stand adjacent to its factory, right? Carrying amount 60,000, fair value 800,000 to Fantasy Limited with the view to collaborate to future collaboration and expansion between the two companies. So do you see that how many considerations do we have? We have three, right? We have this cash payment, we have this asset, and we have this instrument, right? This the shares, right? What we have, and then this is the statement of financial position. Obviously, it's for Fantasy Lights, right? And then they said Fantasy Lights was involved in researching and developing a new light bulb that saves energy, right? So, okay, before we go there, I think we can start with the required, right? So the required says prepare acquisition journal entries at 1 January 2019 in a record of Electro Light Limited to account for the information above, right? Do you see that the required does not talk about consolidation? Here, there's nothing about consolidation, and they told us that it's assets and liabilities, right? So what do we know? We know that you're going to record goodwill in the separate financial statements, right? So we are going to do a journal entry that's going to be similar to this. Let me show you. Similar to this, right? Similar to this, right? So how that's basically what they want here, right? Those journal entries, right? So how do we do the journal entry? The first thing is what we debit the assets at fair value. Remember, right? Debit the assets of the sub at fair value, right? So you're gonna say property, plant and equipment, 5 million debit, right? Investment property, debit this 2.5 million, right? And then receivables, debit also this 3.4, right? Because it's the fair value. Don't forget it's the assets at fair value, right? Now let's read the scenario here and check if maybe there were assets that Fantasy didn't recognize, but we should recognize via business combination rules, right? Don't forget, we're still at the assets. So Fantasy Limited was involved in researching and developing a new light bulb that saves energy. Okay, the development cost of 380,000 didn't meet the requirements of IS 38 intangible asset, therefore not capitalized. Do you see that? Because we are already considering developing costs. So development costs, where are they considered? Recognition criteria, right? So that means that this thing was already identified. And according to IFRS 3, right, if the intangible asset it is identified, the intangible asset can be identified, you have to recognize it um so you have to recognize it during the business combination, so during that main elimination journal entry. So here is not a main elimination. I mean, this is the add acquisition. You have to include it. You have to include this is part of the fair value adjustment, right? Right. So we have to include this one. So don't forget here we included the asset, right? All of the assets at fair value. We have to also include this one. Don't forget to include the intangible asset 380,000 debit, right? And due to the acquisition of Fantasy Light by so by okay by electrolytes, yeah, the development cost now meet the definition of intangible asset. You see, it meets the definition of intangible asset in terms of IS 38 and will form part of the business combination. And they tell us that this asset is actually part of the business combination. So yes, you have to do that. You have to debit the intangible asset, and then the fair value of the development costs amounted to not this 380. They said the fair value amounted to 600,000, and the asset must be at what fair value. So you're gonna use the 600,000, not the 380, because it must be at fair value, the asset, like we said here, right? They must be at fair value, right? And then what's going to happen? Let's continue. It says at acquisition date. So far we've debited four things, right? It's the three that were in the statement plus this intangible asset, right? And they said that acquisition Fantasy Limited was in the process of being sued for environmental damage for an amount of 3 million, right? So at acquisition, it was still in that process, right? And then although the damage has indeed been done to the environment, the legal advisors of Fantasy Limited were of the opinion that there's only a 35% chance that the claim would be successful with their case, and therefore did not view the court cases being probable to succeed, right? Then now, don't forget a provision, right? A provision is a liability in the separate financial books according to IS 37, right? However, a provision is only recognized when what? When it's probable, right? So there's a more than 50% chance. So definitely this is not a provision. That's why you don't see any provisions here, right? On the liabilities here, because this was not a provision. It was a contingent liability. Do you see? Because it was only disclosed, not recognized. So they said the fair value the of the claim, taking into account all possible outcomes determined as that. So what did they say? Business combination. So business combination says if you have if you have contingent liability, right, that you disclosed, as long as there's a reliable estimate for that contingent liability, you have to recognize that contingent liability. So just like a normal liability, right? At that point. So far we've debited all of these assets. Now we have to also credit, don't forget to credit this contingent liability, right? And also credit all of these liabilities, so the long-term loan and the payables, right? Now, by doing that, what did we do? By doing that, we've done this step. We've debited all of the assets of the sub and credited all of the liabilities of the sub at fair value, right? That's what we've done so far, right? And then what's left is, don't forget, it's 100%, right? So there's no non-controlling interest. So what's left is the consideration. Now we have to look at the consideration that we paid, right? And what did we say we do with the consideration? We credit the consideration at fair value, but the consideration also has to be at fair value, right? So the first consideration is cash, right? Now, do you see that they said this cash will paid in December 2020, right? So do you see that because we have an obligation, because we as the like electrolytes, we have an obligation now to pay this 12 million in December, right? If you have an obligation to pay something in future, what is that? That's a liability, right? Because equity, you don't have an obligation. You have to pay them, but it's not obligated. Liability is obligation. So as long as there's an obligation to pay in future, you are liable for that. So that's a liability. You have to pay it however when in future, right? So now, do you see that this future, this payment is actually it's a deferred payment, right? So the term for it is a deferred payment. So what happens is because you are paying it in future, right? You know that this thing, so because you are paying it in future, right? More than 12 years, you have to calculate the present value of this loan now because this is its future value. This is what you're gonna pay, right? So you can't credit this and say loan. You have to credit the present value, and then as time progresses, right? Accumulate that loan with interest, right? So we have to determine the present value of this amount, right? Using what percentage? This percentage that they gave us here for financing, right? So we are going to have this calculation. Do you see here? To calculate the present value, two is for the number of years because it's 2 years, like the acquisition date was January 2019, right? 1 January 2019. But we are paying it in 31 December 2020. That's 2 years. The percentage I said we use 12, and this is the future value. So the present value is 10 million, right? So you're gonna credit this amount, 10 million. So that's the first consideration you're gonna credit, and then the second one is they tell us that the electrolytes will settle the remaining part of the purchase price through an issue of 60,000 shares, right? So the second one is this issue of 60,000 shares, right? So what's going to happen is that these 60,000 shares, what's going to happen is we are what we are we are settling this acquisition with these 60,000 shares, right? So we're gonna have to credit what are we crediting? Share capital, because we are issuing our own shares. So share capital with 60,000 times 20. So times 20. Why? Because this 20 is the fair value. Like we said, the consideration has to be at fair value. And the fair value here, even for this amount here, the fair value, it's its present value, right? Which is there was 10 million. Here is what? 60,000 times the 20, which is I think 120,000, right? So it's I mean 1.2 million. Yeah, 1.2 million. And then the last one is they tell us that electrolytes will transfer this factor. Now, this factor, do you see that in their separate financial statements, right? It is it is at carrying amount. So far in their SFP, they have this carrying amount, right, of 600,000, right? That's what they have. Now, we said the consideration must always be at what? At fair value, right? So the first thing you're gonna do, right? The first thing you're gonna do is you're gonna have a journal entry that firstly adjusts this factory to what? To fair value, right? So you're gonna have this journal entry that adjusts this fair value to, so that adjusts this carrying amount to fair value, because that's what you're gonna be transferring, right? So what happens is you're gonna say what? That factory, right? So um that factory on a debit, right? Factory debit, right? So PPE debit with 200,000, and then gain on fair value adjustment, you credit, right? Because this is a fair value adjustment of 20,000. That's where you start, right? And then don't forget that's not part of the journal entry, that journal entry that you're doing. So what I just did now, it's a separate journal entry. It's not a part of this journal entry that you are busy with, right? So you do it separately. And then now, what is the lender? What is the PPE amount now? The PPE amount is 800,000. You see, because of the journal entry we just did, it's 800,000. So now you can effectively remove that 800,000 and say PPE we credit with the 800,000, right? So what is the consideration in the journal entry? It's that 800,000 from PPE, right? It's that 1.2 million, right, from the issue of shares, right? And then is this 10,000 present value, right, from the loan. That's the consideration. That's what you're gonna credit, right? And then, like I told you, whatever difference is left, it's either going to be goodwill or gain on bargain purchase, depending on whether you have a credit or a debit amount, right? Debit balance. Let's just see if it was correct. So like I told you here, PPE, they just took this 5 million. Do you see? Investment property, they took the 2.5. The 3.4 comes from the receivables, right? Then the 600,000, like I said, it's the intangible asset here. Do you see? And you see they used fair value, right? Like I said, this list, explaining it in detail, I'll also send it, right? And then do you see that's all they debited? So that's what they debited first. And then we go to the credit side, right? They firstly, what did they credit here? Long-term loan. Do you see this long-term loan? They got it here, right? They credited the payables, right? The 400,000. The payables, we got them here. Do you see? Then what did they credit? 180,000 of the contingent liability. Like I said, now you have to recognize this contingent liability, right, by crediting it. That's what they did. And then now the rest that we're doing here. So firstly, with this 10 million is the consideration, right? Like I said, consideration you have to credit. So they firstly credited this 10 million present value, right? Yeah, from this point here, 10 million. And then Secondly, they credited the what? The PPE, right? I don't know why they said land here because they didn't specify here. They just said electrolytes will transfer an adjacent a stand adjacent to its factory. Okay, yeah, a stand. Yeah, a stand is a land. Okay. So a stand adjacent to its factory. Like I said, they did this in our entry here. This is confusing. Do you see why? Do you see land here? They said 600,000, right? And in my calculation, it would have been what? It would have been 800,000. But this gain on transfer of land, you wouldn't have had it, right? It would have been separate. So you would have had a general entry at the side before this. So separate to this, we would have had a general entry that said land, right? We we debit with an amount of 200,000, right? That's what we're gonna do first because we know that the land balance so far is 600,000. So we're gonna do this first and then credit the gain on transfer of land, right? Gain on transfer of land or a fair value adjustment. It doesn't matter what you say because it's gain on fair value adjustment anyway. So you can say transfer of land or fair value adjustment. Yeah. So that's the 200,000, right? Right. And then in this general entry, you're just gonna have the 800,000 here, right? But this gain on transfer of land, it won't be there, right? Because yeah, we don't credit income, right? We credited we created the land because this was the consideration, right? This was the consideration. So the way I like to do my journal entries is via story. So here, this journal entry does not really tell me the story that I want to hear. Like with this gain on transfer of land, it doesn't make sense that I'm using it in the acquisition journal entry, right? It makes more sense to say land 800,000. However, the amount that they get is still the same. Why? Because do you see that they put this 200,000 here? Whereas I would have put the 800,000 here, but this amount wouldn't have not been there. Numerically, it would give us the same goodwill, right? And then what did you say? That last 1.2 million is for what? Share capital, right? So that last 1.2 million is for share capital, right? Um, this share capital, this consideration here, right? And then they aggregated the credit side and the debit side, and they got a debit of 2.8, so 2,080,000, and this is the goodwill, right? See, they aggregated the assets and liabilities, calculate the goodwill, and then yeah, that's basically the implication side of it. Like I said here, they only did it until acquisition, right? So I didn't do since acquisition. If you wanna see since acquisition, please refer to the third year BCom session that you're gonna do. Yeah. And do we have any questions? Any questions? Okay. Um, if you don't have any questions, um, okay. Thank you, and yeah, see you next week.